All right, welcome back. You're watching The Money Show on ET Now. Well, it's that time of the year when a lot of you, I'm sure, may have either by post received annual reports or then at least got them on your email. I would reckon the latter, given the fact that we do live in the no-touch digital era. So you've got those emails flowing into your inbox and you just think, okay, yet another annual report, and you'll probably move it aside to another folder, or in the worst case, you'll probably delete it as well. But this annual report can actually help you in reviewing your portfolio, which by the way you should do quite frequently, and decide on whether you should continue to stay invested in a particular company or not. So how is it then that you can extract the most information from this annual report, which at times can be quite a thick booklet running into hundreds and hundreds of pages? To talk about this, I have with me an investor who of course has poured through thousands of annual reports, if not more. Gurmeet Chadha, co-founder and CEO of Complete Circle Consultants. Gurmeet, thank you so much for taking our time and joining us today on The Money Show. Gurmeet, most of our viewers, they are your regular retail investors. They may not exactly be completely savvy with finances, accounts, and all the technicalities that are associated with it. But tell us, Gurmeet, what is it then in an annual report that you first scour through for when you lay your hands on it?
Yeah, thanks, Mubina. I think it's an interesting session on this. I understand. It runs into tons of pages. Not easy to practically go through all reports if you're holding a lot of stocks. But it's the most insightful and most factual description of not only just the finances of the company, but the way company thinks about going about its business. So it's actually a storehouse of both information as well as insight. And every information is technically official. So the company can be sued in case there is any factual inaccuracy in it. So 3-4 things one can look for instead of it's not possible to go through the entire report. You can start with the director report. The director report essentially talks about the financial performance of the company. So how's been the top line growth, how's the bottom line growth, what are the EBITDA margins. In some cases, they will cover some return ratios as well. And it generally talks about how the business fared. And it gives you a bit of a trend in terms of how the business has fared over last few years. The second thing which I look forward to, very in detail is the analysis, which is also called the MDA. Which is how the management discussion and analysis, right? Then it talks about, the economy, the business landscape, how's the competition, So if you look at Asian Paints annual report 1920, it talks about how, discretionary paints is actually a proxy to domestic GDP growth, how the global environment had a bit of an impact. It also, in fact, talks about how the tough financing conditions impacted infrastructure financing. So it's very, very insightful if you get a time and get hold of, the Asian Paints MDA. So it gives you an entire perspective. And then the most important is the financials, right? You want to look at, how the P&L has shaped out, how's the balance sheet looking, what are the cash flow statements. So financial statements basically have 3 parts, which is income statement, which is P&L, balance sheet, and then is the cash flow statement, which is the reality in terms of how much money companies are making. And then you go through auditor reports, etc. So these are the 4 or 5 things I look for when I see an annual report.
Gurmeet, let's take them one by one, each of those topics. First, MD&A, or management discussion and analysis. Now, if the management has to talk about the company's performance or about, what the prospects are like, or, how the industry is looking, he or she will have the tendency to always paint a bit of a rosy picture. So how can an individual critically analyze, look through it with a critical lens then?
Excellent point, Mubina. And I think that's what differentiates, good companies from great companies, right? The great companies give you a true picture. So if you look at, for example, DV's Labs in terms of the if the MDA part, it talks about so if you see their heading of the report changed from, they used to publish it in the name of sustainable chemistry. and then they change it into, the sustainable environment, the sustainability part of the world, right? So that marks a shift towards that, in kind of the impact the COVID wave has had on supply chains, on individuals, on your socioeconomic, landscape. So if you look at something like a Divis Lab, it will talk about the challenges, the supply side bottlenecks, what is the API business about, what are the disruptions we are going to see. It also talks about nutraceuticals. It talks about how big the global outsourcing environment is. So it's a good companies actually give you a balanced picture. And you're right, in some of the cases you only get and if you're all getting only rosy things, and that too also, even if you club that with financials, so just painting a rosy picture may not be a red flag. But if there is a rosy picture and along with financials you are seeing sudden jump in revenues or sudden overstatements on assets, then combination of that with financials could be potential red flags.
Well, yeah, Gurmeet, numbers will always reveal more than, words do, because, quantitative aspects are purely objective, but qualitative, of course, are completely subjective. So what would you look at in terms of red flags or potential red flags, Gurmeet? You've seen so many annual reports. I'm sure there have been some annual reports which have made you a little suspicious. So, if you could share some examples as well of, what those red flags have been, which have made you think that, okay, there's something going on with this company, or something like that.
So there are plenty, but for the sake of time, we can discuss, let's say, two or three. So one of them is, inconsistency in revenue, sudden spikes, in revenue, and it could be for the fact that you are actually doing those sales to your sister party or subsidiaries, and jacking up those numbers up, right? The second could be sudden rise in, let's say, receivables. At an example of suddenly high sales and some too good to sell numbers was 1% beverage. And then we saw, how cooked the books were. The other example where we saw very high account receivable is a sign that, you're not realizing your dues on time. We saw that with Z. Their inventory turnover ratio and the receivable days were very high. It was almost 3-4 multiple. So that actually told you that a lot of the money is getting stuck, and now if you see, we realize that how much they owed the companies like City Cable and Dish TV owed. So that's the second one. Third is, if let's say your sales are static and falling, but your gross margins are going up, right? That's a red flag. I mean, if your revenue is on a decline, chances are you're understating your expenses, or you're using off balance sheet items to hide a few things, or you're shifting some expenses to the next financial year. Those could be some of the red flags. Another red flag is capitalizing your expenses, right? You might want to, so expenses are accounted for in various ways. A lot of infrastructure construction companies have been accused of capitalizing their expenses. So these are some of the red flags. Always look at growth, that numbers which you see, which is stated revenue growth, with growth in, let's say, profit, along with cash flows, real cash flow. That's why you have three parts to it. The P&L, the balance sheet. Balance sheet gives you how effectively you have utilized those assets, and the cash flow actually tells you how those assets have been sweated to generate the necessary cash levels.
So basically, P&L and cash flow, it's a good idea to sort of read them in conjunction. What about balance sheet? Because personally speaking, from experience, I always find that account statement a little difficult to read. What would you try to spot in terms of a trend, perhaps, in the balance sheet?
So a few things, look at few financial and return ratios, which will give you an idea. So you can get an idea on the debt equity ratio. If the debt levels are going up significantly, I think that's an alarm. You look at in terms of how good you are in terms of meeting your current obligation, which we also called as the current ratio, which is current assets by liabilities. Typically, more than one means that you are comfortable meeting any short-term obligations. Look at if someone is really trying to jack up the value of the assets or overstate intangibles, right, like goodwill, etc. Right, if there is any sharp movement there, that can be looked at. So a lot of return ratios, you can also go to some websites and get those return ratios. But it's good if you see those ratios and and try and make sense of it by looking at the balance sheet, then probably it will make more sense. Also, I think look at what's the growth in the net worth of the company. So let's say example, Pidilite. Pidilite net worth is basically your reserves and the original capital you started. So if you see Pidilite, their net worth and reserves have actually gone up from 2,600 crores in 2016 to now almost about 4,500 crores. That's like a 14-15% growth, in your net worth. So this is what actually is telling you is that you're making money, you're redeploying that money, and in the process, and your margins are being maintained. It has a high ROC of almost 34%, which means that's a great return on capital employed, and your reserves are getting created and net worth of the company is going high. So look at a trend. Don't look at numbers in isolation. Growth in top line, good margins, more is the value add, more will be the profit. How much of that profit is getting reinvested, and in the end, how much is the net worth getting increased by?
All right, Gurmeet, it was a pleasure having you with us. I know we could continue this conversation for hours and hours, but well, we have our time constraints. Thanks so much for joining us today on the show, and at least giving our viewers the first few steps that they should take when it comes to reading annual reports. Thanks once again.